What makes a great dividend-paying ETF? A dividend-paying ETF can be a great retirement strategy in some circumstances, but it's important to do your homework. So in this video, we're going to have a look at what makes a great one. Hi there, Jared Brown here, Australian Expat Financial Planner. In this video, we're having a quick look at what makes a great Australian dividend ETF, particularly if you're looking to derive a passive income or set yourself up for your retirement goals. There are a number of different ETFs, exchange-traded funds, listed on the Australian Stock Exchange. Now, an exchange-traded fund is simply a fund, a collection of investments that trades on a stock exchange, in this case, the Australian Stock Exchange. What it means is that as an investor, you can log into your trading account, your brokerage account, buy a single asset, being that ETF, that gives you exposure to those underlying investments. It's one transaction, it's typically passive, it's relatively low cost, and often designed to serve different purposes depending on what you're after. So when we look at dividend-paying ETFs, what do we need to consider? What should we be looking out for? Number one is the actual reputation, the size of the provider, the market maker that sits behind the ETF. Is it a Vanguard? Is it a BlackRock? Is it a State Street, VanEck, BetaShares? Or is it a smaller provider that may have less of a reputation, may operate much smaller funds, and therefore carry a bit more risk? Number two is the fee, the cost of actually investing in that ETF. Now, we've seen costs of ETFs go down, continue to fall over the years, and this trend is very likely to continue. A lot of them are very cheap, but it's not always the case. So review your ETF. If it's anything over about 0.5% for a dividend-paying ETF, chances are that might be a bit too high. Review your options, consider what's right for you there. Number three is the actual number of holdings within that ETF. So how many shares are actually within the dividend ETF that you're investing in? Is it 50? Is it 100? Is it 200? Is it over-diversified? Is it under-diversified? What factors, or what is really the actual mandate when it comes to the investments within the ETF? Number four is how the actual strategy or how the mandate for the ETF actually works. Now, by this I mean when it comes to a dividend-paying ETF, how are the stocks selected that go into the fund itself? Is it purely based on yield, or is there a little bit more to it? Does the ETF or the fund provider, manufacturer, actually look at free cash flow, at the actual yield over time, at the return on equity, or are we just left with a pool of different investments that have a high yield that could in fact be a yield trap, and we're just waiting for those dividends to be slashed? And number five, which I would say in many cases is one of the biggest ones of all for anyone planning to retire in Australia, is the franking credits that are associated with the ETF. Now, a franking credit, again, you can check out our previous video on what a franking credit is, how it works, but in simple terms, it's designed to avoid double taxation on dividends that are received. If you hold a pool of dividend ETFs or shares inside your super fund, and you're in pension mode, you're retired, you're drawing down those funds from your super, paying a rate of tax of 0, then the franking credits, or the tax already paid by the companies within the ETF, would be received by you as the investor in the form of a credit. What this means is that effectively your yield, or the return on your investment, actually gets a bit of a boost. So there you have it, some simple factors to look at when considering what ETFs to invest in, what to buy when you're planning your retirement. A few great examples in Australia. We've got the Vanguard High Yield Fund, which invests in the high-yielding ASX 200 shares on the Australian Stock Exchange. You've got the Global X ASX 200 Dividend Fund, and we've also got the Spider Australian High Dividend Fund as well. They tend to be low cost, they tend to be some of the biggest options, but there are plenty out there, so certainly do your homework, seek advice, and plan your retirement accordingly.